Hi guys, what's up? We're going to do another Y as well. Today we're doing a big one, bubbles. So what is a bubble? Essentially, it's an economic cycle that's defined as the rapid escalation of market value of assets. So the rapid escalation of housing prices, stock prices, whatever you want. The asset value becomes inflated because the value of the asset exceeds the asset's intrinsic value, or what the asset should be valued at, by a very large amount. Now, what do we know about markets? They usually correct themselves. So the fast inflation is usually followed by a very rapid decrease in value, or also known as a contraction. You can say the bubble bursts. Bubbles are typically caused by a change in investor behavior, and there are 5 stages. So what's the first stage? Displacement. When investors notice a new product, technology, service, low interest rates, whatever it is, they're going to put money into the investment, right? Because they think it's a good investment. So what happens when they put money in? The prices rise. The assets gain more momentum as more people put money in, and then this causes a sense of FOMO, which people are going to see the asset price rise. They're going to say, "Oh, damn! I wish I should have put money in. Right? I should have put money. I should have invested." So that's going to cause even more people to drive up the price of the asset. Then what happens? People see the asset prices skyrocket, which causes everyone to throw their caution out the window. Nobody's thinking about what could happen. Everyone's like, "Oh, this is so great. This is great." Nobody thinks about what could happen, and then some investors, they take off their positions, sell them before the bubble bursts, which is very hard to predict when it will burst. But once the bubble bursts, it's not going to inflate again. And what does this cause? A panic. They see asset prices drop. Now everyone wants to liquidate their positions as soon as possible. What does this cause? Chain reaction of drop in asset prices because the supply is greater than the demand of the assets. Now we have 2 examples of very famous bubbles. First one is the dot-com bubble, which was a rise in equity markets, which was fueled by investments in early internet and technology. This was speculative investing and an abundance of venture capital. Investors started to pour money into tech/internet startups. And what happened? As technology internet became more advanced, most of the companies become filtered out because that's usually what happens. Many companies didn't even make a profit. However, they still offered initial public offerings or IPOs. But after some time, there are lots of companies where we're unable to keep accessing the capital they had been getting from the investors. So what happened? Their capital started to dry up. People saw that, panic started ensuing, and people started to sell. This overall just led to about a 10% decrease in the stock market because when people sold, obviously the value would go down. Here you can see a chart of the dot-com bubble. And the next example is the housing crisis, 2008. So what was this? The value of real estate started to rise. The demand for home ownership started increasing at very high levels, and interest rates started to decline. So what do we get with these 3? The value of real estate started to rise. Obviously, people wanted to buy houses, right? Because you want an asset that's going to go up in value. And low interest rates meant it was easy to pay back the loans because you wouldn't have a high interest rate on the loans, right? Everyone loves that. So at a low interest rate, people are more inclined to borrow money, more inclined to buy a house, especially since the value is rising. And what do we get? Bankers reduce requirements to borrow and also reduce the interest rates that customers will have to pay on their loans. They implemented this thing called adjustable rate mortgages, which you could refinance every 3 to 5 years at a lower adjustable interest rate. As the stock market started to rise again, so did the interest rates. And what happens when the interest rates start to rise? Mortgages started to refinance at a higher rate, which means the value of housing went down. Why? Because not as many people want to buy houses because the interest rates were higher. And what happens when the housing went down? Triggers a sell-off in mortgage-backed securities. Now, what are mortgage-backed securities? Essentially, it's just securities that are backed by people paying their mortgage. But if people couldn't pay their mortgage, what happened? People defaulted. And what happened when people defaulted? Price went down, caused the bubble to burst. Now, this asks the question: are we in an AI bubble right now? Obviously, we all know what happened with Nvidia. We know what happened with all the tech companies right now. Is it a bubble? Personally, I don't think so. I think AI is the future, but who knows? It could be a bubble, right? That's essentially what a bubble is. Thank you for watching. I'll make another video in the near future. I'm not sure about what, but thank you for watching.